Okay, so for those of you who don't know me, I'm Ali Shourideh. I'm an assistant professor of economics as of July. I'm an assistant professor of economics at Carnegie Mellon University. I've been working, especially recently, a lot on issues regarding what I call adverse selection in various markets, in financial markets, insurance markets, and so on and so forth. And we don't really call it market design, but seeing what Mohammed and his colleagues do, why not? We can call it market design. Okay, so just to give you a little bit of introduction of what I want to talk about today, most of the stuff that you saw, ignore the kidney exchange part of the stuff of the allocation problems that you saw in the previous lecture was about private value problems, in the sense that I want to sell you a cell phone, an iPhone. Some of you, this iPhone has a cost for me in terms of production. Some of you like this iPhone a lot. Some of you don't like it a lot. That valuation that you have for this good is not necessarily correlated to the cost that the good has for me. Okay? This is what we call a private. So most of what Mohammed was talking about was a private value problem. Whereas in a lot of economics, the allocation problems arise when we have a common value problem, or that's when we want to call stuff when there is adverse selection. So the classic examples are. So by the way, when I say common value problems, we have to be careful about this. What I'm talking about throughout this whole talk today, I'm going to talk about a situation where the valuation of buyers and sellers are perfectly correlated. Okay? So just to give you a sense, think of it, the classic example of this, going back to Akerlof 1970, this is the classic example is a used car. If I sell you a used car, I know what this car has been going through. I know if there was an accident, if I had to change the timing belt, so on and so forth. And all of this will affect how the car is going to work for you. So I have private information about this, and this private information is also relevant for you. So you see where the values are now correlated. How much I value the car is very related to how much you value the car, and so on. And you have no way of knowing besides maybe running some tests and so on. So this is a classic example. You can go more advanced and talk about more advanced allocation problem, more advanced markets. The market for insurance is the perfect example for this. When you apply for any sort of insurance, say, when you try to get health insurance or, insurance against death, annuity insurance, life insurance. By the way, feel free to interrupt me if, some words that I use are not very familiar. So if you want to get life insurance, health insurance, you as a person know more about your, health status than the insurance company that you're buying this insurance from. The insurance company also cares about this because how much they have to pay you in case of an accident, in case of a surgery, in case of a heart attack, depends on the risk of you becoming sick. And so these two values are, again, correlated with each other. Right, beside what Mohammed was talking. This information, presumably, is private to me. So think of it as, maybe I have a heart attack, so think of the following situation. I've had a heart attack in the past year, but and that information is hidden. I only know that information. So then when I go get an insurance, I know that I'm more prone to maybe heart attacks in the future, but the insurance company doesn't. So that's an example of this. You can also think about the same situation arising in asset markets. So, if I'm trading with you, I might know something, I might have some private, so say we're trading Apple's stock. I know something about Apple's stock. I know that, Apple is going to come up with this new product or this new software a month from now, and you don't. You care about this information, and you'd like to know that information. So again, our values are correlated with each other, perfectly correlated with each other, and we like to design trades in that situation. So what I'm going to talk about today is all about this, situations where we have common values as opposed to private values that Mohammed focused on. So the basic thing that I want to talk about is basically how can we organize decentralized trades, okay? And what changes? What is the key thing that's going to be different? So that's all I have to say about introduction. So what I'm going to talk about today, and I'm going to show you some, start from some plain vanilla models of adverse selection, make it a little bit more complicated. So I'll show some theories first. Then I talk about some application, again, rather theoretical applications to insurance and finance. And if I have time, I'll talk about how do we identify adverse selection, some empirical approaches to trying to see if markets do have adverse selection or do have this problem is significant. So that's going to be the plan for the talk. Okay, so let's get to the model. So the situation I want you to think about is the following world. A world where two goods are being traded, an indivisible good, one unit of good that we're going to trade. Think of it as a car. So think of that used car example that I was giving you. We're going to trade a used car, okay? And we'll trade this with, say, money or some paper currency or real currency, another good that's divisible, and we will call that numerator, okay? There's going to be three players in this world. There are two, what I call principals, two people who are sitting. So say I'm the car owner, and two of you guys are trying to compete over who wants to buy this car from me. Okay, so you two are the principals who have a valuation of this indivisible good, which I would refer to as VC. Okay, and the agent has a valuation of the indivisible good, that's C. In other words, if I keep this car, so this is very related to what Mohammed was talking about in the bilateral trade example. If I keep this car, I get value C from it. If I give it to you, you're going to get value V of C from it. Okay, and C is some variable. The common value assumption in this case, we can alter this to a negative number too, but I'm going to assume that your value is increasing in my value. If I have a very good car, it's going to work for me better, and it's going to work for you better too. Okay, but perhaps they're different. And there is asymmetric information in that sense that my valuation, which is related to your valuation also, is going to come from some continuous distribution. So f of c here is some CDF function over some interval. Okay? And I'm the one who knows it, you guys don't know it. Okay? So the agent privately knows this. The principals don't. The distribution is common knowledge. So we're not living in a world with ambiguity or anything like that. Everything is common knowledge beside the exact realization of the quality of the car. And if we lived in a perfect world where I just freely announced how good the car is, it's efficient for us to trade. In other words, your value is higher than mine, so it's always, quote unquote, first best efficient for me to give the car to you. The world is a better place, however you want to think about it. Okay, so under full information, when everything is known, full trade is always out. So now we play this game where the two of you are going to make me an offer. So basically you're going to say, the two of you are going to say, this is the price that we're going to be willing to give you. Of these two prices, I'm going to choose which one to trade with. And that's it. That's all there is. Okay? So in other words, I'm going to face these two prices, P1 and P2, and I'm going to sell to you if the max of these two is higher than, sell to the highest price if the max of these two prices is higher than my valuation. So very simple, nothing fancy. In equilibrium, obviously, given that you guys are the same, you have the same valuation, you're going to do the same thing, you're going to offer the same price. You're going to offer price. So in other words, P1 and P2 are going to be equal. I'm going to randomly choose one of you to trade with. And profits are going to be zero. Again, because if there is any profit, you're going to compete and you're going to increase your prices to sort of get rid of all the profits. And so in equilibrium, it must be the case that the expected value conditional on me trading is equal to the price. Okay? And so the problem arises from conditional on me trading, because it's possible that if the good is good, if the value of the car is really high, I won't want to sell it to you at a particular price. So if we just want to, again, this is plain vanilla adverse selection, and a lot of you might have seen this, but I thought it would be useful to start with this. But feel free to ask any questions. So if you want to sort of graphically show this for sort of any kind of function v of c in any distribution, this object, expected value v of c, conditional on p bigger than c, is some, function. There's no regularity to it, effectively. It can have any sort of shape you want. And here what I have is 45-degree line, and the equilibrium is going to be one of these 3 points, except that it can only be this point. Why is that? Because this is the highest value where the conditional expectation is equal to the price. If price is any of these 2 other values, you always have one of the buyer principals always has an incentive to offer a price epsilon below this. They're going to make positive profits. I'm going to trade with them, and everything is good. But you can see the result from this model is that some people are excluded. Some cars are not being sold, even though it's very efficient to trade them. Okay, and so this is what we want to refer to as adverse selection. The selection into trading activity is adverse. The guys who are selling it are the guys who are low quality. And so if you think about this in terms of insurance, in the insurance context, it would be the case where the guys who are, now you have to reverse the role of seller and buyer, and the guys who are buying insurance are low risk, are high risk people. And low risk people are basically not going to be buying insurance. Okay, so that would be what this means. So the shape of this, sort of the nature of the equilibrium, kind of depends on the fundamentals of the model. So it's going to depend on the distribution f of c. It's going to depend on gains from trade vc minus c. If vc minus c is very large relative to c, there's going to be a lot of trade, and it's also possible to actually have this be above this line always. So in other words, if v of c is a gazillion plus c, there's going to be always trade. There's no problem. Going back to Akerlof's original example, Akerlof came up with examples where there's actually no trade, in the sense that I think the example that he had in mind was something like C has a uniform distribution, V of C is 2 times C, and in that situation there will be no trade. So nobody will sell. So this is a complete breakdown. One caveat or one note that I want to tell you is that this is actually efficient, in the sense that if you give it another quote-unquote central planner to have an ability to be subject to the same information problem. Again, he doesn't know whether my car is good or not, but he doesn't have to, optimize and so on and so forth. Again, you're going to get the same outcome. You're going to get basically the same. So this outcome is sort of is efficient outcome. So kind of a product design question that comes up after this simple example. So a lot of you have seen this. This is the plain vanilla, adverse selection masquerade, chapter 13 or something. 14? 14. The issue that comes up from this is a product design issue, which is that, especially think of the insurance example. The model basically says there's one single insurance product that I'm selling to you. I'm buying from you. If I keep you guys principal, myself agent. There's one single product. I only have the option of buying one single product from you guys and nothing else. And of course, since you have to pool a bunch of high-risk guys with a bunch of low-risk guys, you're not going to give me very favorable odds. You're not going to give me good prices because you're worried about losses coming from these high-risk guys. So if I happen to be a low-risk individual, I'm not going to buy it. So that's basically the idea. So you would think that if we introduce new products, maybe we can get these high-quality or low-risk individuals to buy stuff too. In other words, think of the following way. An insurance company can come in and say, okay, so it used to be that I offered you this one single product with full coverage, but really high price. And you're a really healthy person, you don't want to buy this from me, I understand that. Let me offer you another product which has a lower price, but has less coverage. In other words, every time you go to a doctor, you have to pay a certain amount of money out of pocket. The insurance doesn't cover all of your all of your health expenses. Right. Oh, that's what they call it, franchise. Okay, good. In the US, they call it co-pay or co-insurance, where you pay out of pocket. So in that case, what is the high-risk person going to say? If you know for sure you're going to end up going to the doctor or doing a heart surgery, you're going to say, no, I've got to pay out of pocket. I don't like this option. Yeah, the price is low, the premium is low, but my coverage is also low, so I don't like this option. The low-risk person who says, oh, just think of the extreme example. The guy says, there's no way I'm going to have a heart attack in the next year. Why should I go for but there's some small chance of having a heart attack. I'd rather insure myself. I buy this low coverage, low price insurance scheme. The other person is going to buy high price, high coverage insurance scheme, and we are all good. Okay? So that's sort of a product design kind of issue. That maybe the situation that we considered before sort of excluded a bunch of guys who were getting benefits from trading, but introducing new products is going to do that. So let's see if it actually works. So I'm going to think mathematically about a product as a level of coverage X and a price P of X. So let's be clear about what X is. If you're an agent and you so again, remember, we're going back to the situation where you're selling the good. Okay? You're selling the good. The agent is selling the good to the principal. But you can easily reverse it in your head and think of the other mathematical formulation. But think of it that the agent is selling the good. He's selling X unit. Now X is a continuous variable between 0 and 1. At price P of X, so now price depends on how much you sell. And of the stuff that you don't sell, so say you have 1 unit of the good to sell, you eat the rest of it and your valuation is C. Okay. The principal on the other side is going to get V of C, the valuation, on the number of units that he buys from the other person, and he has to pay X PX. So PX is the unit price, X is the number of units purchased. So as I said, in the context of insurance, this would be, what we're talking about, franchise or level of coverage or copay, any sort of out-of-pocket expenses. You can sort of think about it that way. In terms of finance, do you guys know about mortgage-backed securities? You do. Or you don't? You do. Okay. So in terms of mortgage-backed securities, if you're an underwriter of a mortgage-backed security, sorry, I just don't know, I have to assume, whatever. So if you're an underwriter of mortgage-backed security, you're the guy who knows what goes into the mortgage-backed, what pool of mortgages is going into them. And an outsider can say, if you're going to sell it to me, you got to hold some of it on your balance sheet. So that would be the context of finance. Okay? And this X would be, you're selling, this would be exactly the finance example. You're selling X unit at price P of X, and you're holding 1 minus X on your balance sheet. Okay? And you can also think of it as, in a lot of financial markets, price trades are done in very segmented ways. Large trades are done away from small trades. Small trades are done we'll get to that one applications. But you can think of these price differences again as a form of price discrimination or nonlinear pricing, where if I want to. So what is the issue? If I want to dump 10 million or 100 million worth of stock of Apple in 5 minutes on the market, the price. So what people typically do is they usually do this away from this standard exchange where tiny trades are happening, 10,000, 20,000, 50,000 deals are happening. And so that's another form of price discrimination. Again, the quantity traded would be X in that. So in this world, again, we want to think about the game as before. These two guys, these two principals are offering these schedules. They're going to say, at this price, at this quantity, this price, this quantity, this price, and so on and so forth. And the agent is going to choose which one of these two guys to trade with and how much to sell to them. So X star of C is going to be the choice of the agent conditional on which principal to trade with. Okay? So all good? All right. So now let's talk about what the equilibrium should look like. So first, any equilibrium in this world must be separated. What do I mean by that? That this function, x star of c, is a one-to-one function. In other words, higher quality people will sell more, will sell less actually. This world would be less. Think of the 0-1 model. The higher quality people weren't selling. Here they sell, but they sell less. Okay. So x star of c in this world would be decreasing. So why is that? Suppose I'm a principal, or sorry, one of you is a principal and is pooling some people. That means in equilibrium, you've got to make zero profit. Simple Bertrand competition. Profits have to be zero. And pooling necessarily means that you're going to make money on some people and lose money on some other people. Now think of the people that you're actually making money. The other guy can come in and say, I'm just going to go for these guys and offer them its slightly better terms of trade and make profits and have a profit obligation. It's a little bit more complicated than that, but because you have to keep incentive compatibility, these guys are maximizing and so on and so forth. But that's basically the gist of the intuition of the argument. Okay. So given that the equilibrium is separating, this argument that I just told you also says that the price that each agent is getting is equal to the valuation of the principal. Right? Because if they're not, that means there is profits. And if there is profits, the other guy can come in and drive the profits away. So, in other words, profits are zero type by type. Okay, so now basically we know prices in equilibrium. The only thing that we have to figure out is what are the quantities? What are the equilibrium quantities? And that you can get it off the optimality condition. In other words, facing these prices, each agent is going to maximize this object. This is a simple maximization problem. It has a first order condition. That first order condition, I'm not going to do the math for you. That first order condition is going to give you this optimality. It's like an incentive, for those of you who are familiar, this is like a local incentive compatibility constraint. But it's an equation, it's a differential equation that pins down quantity traded. And as I said before, the derivative of the quantity traded is negative. Higher quality people sell less. Okay? So far what I've said was, if an equilibrium exists, it must be of this form. Problem, equilibrium does not exist. In other words, this result is originally due to Riley, or a simple example of it is due to Rothschild-Stiglitz, 1976. Riley basically generalized, and it's a very dramatic result, in the sense that take any continuous distribution f of c, and think of this model that I just wrote down, gains from trade positive and so on and so forth, then this divisible good model has absolutely no equilibrium. So, the question is, what is going on? Why? Why is that the case? Basically, this idea of separation and making zero profit type by type is very costly. Why? Because think of the lowest type. The lowest type is getting some price. That price is given by V of C lower bar. C lower bar is the lowest type. Think of a guy who is above that. He's getting a much higher price. That necessarily means that the quantity must be lower. In other words, why is the quantity lower? Because the low type, the really low quality person, not to lie and say he's of higher quality, right? So we say, again, as before, higher price, lower quantity. But when we create this really steep schedule of prices, that puts a lot of damper on quantities being traded. And so another guy can come in and say, screw all this separating contracts. I'm going to offer a pooling contract and attract a whole bunch of guys. These whole bunch of guys, yeah, they know that, the prices, some of them prices are going to go down, but the quantity is going to go up. And so this deviation is always accessible for some person. I'm not going to get again into the math of it, but you can always show that a pooling contract that says, pool from the bottom to some level of quality and trade everything with these guys is going to make positive profits, or weekly positive profits, attract all of these guys, and we're done. There's no equilibrium. This deviation is always possible. So So the question, I guess, is, we have this sort of a negative result. Now this is where sort of I think the market design kind of issue comes in. We assume this particular market structure. And this particular market structure and contract structure led to no pure strategy equilibrium. That's another thing I want to say. I don't know, Anyway, so one thing I want to say is that there is always a mixed strategy equilibrium in this world, where these principles are mixing over menus. Okay? In other words, you're going to basically say, I'm going to offer a very steep menu with probably half. I'm just giving you an example. I'm going to offer you not so steep menu with probably half. It's not going to look like that. It's going to be very complicated and continuous distribution over these menus and so on and so forth. But there is always a mixed strategy equilibrium. Then the message from that mixed strategy equilibrium is that this mixed strategy equilibrium is always inefficient. What the forces that we need to make these guys indifferent between different contracts that they're offering is going to create inefficiency, even in the second best sense of the word. Okay? And fundamentally, this seems to be the problem. The problem is that this equilibrium concept, this product design that we allowed, does not, and our structure of our competition doesn't let firms cross-subsidize. So, think of a standard insurance company. Standard insurance company is going to say, yeah, I'm going to create different policies, but not everybody who chooses the same policy are going to be the same. Some people have different risks and so on and so forth. And that means that I'm going to, make money on some of the types and lose money on some other types. Whereas this equilibrium concept does not let that occur. Anytime you make money on some type, somebody, the other person can come in, your competitor can come in and try to grab them from you. And so this is a problem with this sort of a market structure. So that's why this is ultimately a market design question. What kind of sort of market mechanism should we allow to let these guys do cross-subsidization and achieve efficiency? Because right now in this situation, with this particular market structure, we don't get efficiency. Okay? With mixed strategies. So to be honest, for the continuous case, that problem, nobody actually wrote down the solution to that. For the case with two types, so think of it as C can take two values, CL and CH, and there's been some work, and I have also some work that I will talk about that. But I have not seen people actually quantify it. In other words, I know I can tell you the formula, and I can tell you the loss in trade. But what I can't tell you is we need to apply this to some sort of insurance market and put actual real numbers in it. I don't think that has been done. But the thing that's been done is a lot of people took this result, these inefficiencies that come out of adverse selection models, and sort of said we need government intervention in these markets. And what I'll show you is that, not interventions in terms of market design, not intervention in terms of how should people compete and what kind of contracts should be designed, intervention in terms of, we need to subsidize or tax certain contracts or not let people write certain contracts. So, for example, a big issue that came before the whole Obamacare, legislation was this issue with pre-existing condition. You have the example that I gave you before. If you had a heart attack before, when you go get an insurance, is the insurance company allowed to make the terms of the insurance conditional on your heart attack or not? That's actually public information. It's not even private information. It's public information. Everybody knows that. So now the Obamacare in the health exchanges that they're running right now, that was a big deal. So, it used to be that so there were a lot of cases like this. People had insurance with their employers. They would have a heart attack. They would lose their job in the Great Recession. When they apply for a new insurance, after they lose their job, the insurance company would say, no, we won't give you an insurance because you've had the heart attack. Now you're just too costly. We're not going to give you insurance. And so now Obamacare has ruled that out in these private health exchanges that they're running. These pre-existing conditions are ruled out. So again, some of these regulations come from sources like this, some sources of arguments like this. What I'll talk about is, I'll talk a little bit about, hopefully later, of how to sort of design insurance mechanisms, market mechanisms to achieve efficiency in insurance. But hold on to that thought. So the first question, or market design sort of question, is can we come up with situations that allow for cross-subsidization? Make money on some guys, lose money on others. There are a bunch of, when you think about this equilibrium concept that I was talking about, there's a bunch of caveats. One thing that I assumed was that, I'm the agent, there's two of you guys. If I sign a contract with you, the other guy tries to come and match in, I can costlessly switch from you to the other person. In reality, that might not be the case. In other words, it's possible that you're offering this particular, say heart surgery in your insurance, and the other guy is not matching it, and I really need that service to be provided. So I can't quite switch easily. Or it could have all sorts of different reasons. It could be that, the hospitals that you cover as an insurance company are in certain parts of town, and I like those. You see what I'm saying? Some independent benefit from these insurance companies. So in reality, that's not the case. In the model, that's not the case. For principles is we're assuming that all of these guys can costlessly create these products. At no cost, I can generate an insurance contract, but in reality, that's not the case. Somebody should sit there to claim the processes, and so on and so forth. That's done. And the other thing is that we really sort of simplified this world to a one-agent world. Whereas in reality, insurance is always done across different people. Potentially, that means the choices that I've made can depend on the choices that you've made. And so we're not allowing for that too. So in the rest of the talk, I'll try to relax some of these assumptions. Do you guys know how much time I have? Half an hour, really? All right. So I have this paper on switching costs that you can read. I don't want to waste time on that. Basically, what we do is, the gist of the story is that we say it's possible that the agent is stuck with some of these principles. Okay, in other words, I cannot switch. So the idea is, with probability pi, I can trade with both of you, both of the principles, but with 1 minus pi over 2, I can trade with only one of these two. Or total with probability 1 minus pi, I can trade with only one of these two. And so, we drive the equilibrium conditions and the contracts that come up, that this allows for cross-subsidization and so on and so forth. And we prove some results. I don't want to get into it since I have only half an hour. Okay, so let me talk a little bit about something that I don't know that much about, which is finance. So let's go to, what is the plain vanilla model of asset pricing that we've all seen? It's the Breeden, model of asset pricing, which is, how do you price securities? You look at the dividend process for the security and you price it. That's what it is. What are the assumptions? Basically, the assumption that it makes is that all the stock markets are Walrasian, in the sense that there is a single price. Agents can only trade, can take it as given. They don't impact the price when they execute the trade. And they can limitlessly, trade. That's the standard asset pricing model that, is still used in finance and so on. So now let's talk a little bit about how does it work in practice. How do trades actually get executed and what financial markets actually look like? Okay, so the very common platform for trading stocks or ETFs or options is the electronic limit, what we call now electronic limit order book, which is an environment where people can submit various kinds of orders, but for now we can talk only about two of these, which is limit order and market order. So when you submit a limit, so what is a limit order? Limit order is an order which says, I'd like to sell sell quantity Q at any price above my threshold P until a certain amount of time. Okay? You can put cancellation time in there, you can not put cancellation time in there, you can come back and cancel and withdraw your order. But basically that's what a limit order is. And for a buy order, it's the reverse. You can also leave market order where you basically say sell at best price and buy at best price possible. Okay? In other words, you go to your broker and you tell your broker, this is what I want. Okay? Now, how does it work? How does it look like? So at any moment in time, this limit order book looks like something like this. Basically, it's comprised of a bunch of orders. So we have here on the ask orders. So these are the sell orders. So these guys want to sell at a I don't have numbers here, but there's this much order for selling at this price. There was another order, sort of a smaller order at this price, a bit larger order, and so on and so forth. So these are sell limit orders. At every point in time, this is the sell side of the market. The buy side of the market looks like this. Again, buy at this price and so on and so forth. We refer to the minimum sell price as the ask price and the maximum buy price as the bid price. And of course, any functioning market, ask has to be higher than bid always. And this is the bid ask. So at any point in time, when you submit your market order, so say you want to buy a certain number of stocks and you submit, I don't know, $100,000 worth of Apple stocks. What your broker or what the market maker or dealer or the limit order book is going to do is going to go up these orders and aggregate up to 100,000 and execute. In other words, this is the price that you're going to pay for the first bit of it. The price that you're going to pay on the second bit of it is this, and so on and so on. Okay? And so that's for market orders. Limit orders are going to be sitting there. If there is another limit order exists that's compatible with this, or if there's another market order that exists that's compatible with this, it's going to get executed. Okay. So that's basically the way markets are run. A lot of securities are traded in these markets. When we think about, say, options or derivatives or commodities or FX, these are traded on over-the-counter markets, which are not like this centrally organized. But ETFs, stocks, and options, I think most of them are exchange traded and run by limit order. Another thing I want to mention is that there is a time advantage in terms of your order. In other words, if I come in and put an order, and you come in and put an order at the same price, and if the one that is going to be executed most of the times is the one that came in earlier. Okay, so there is this time advantage. Okay, that looks nothing like the Walrasian model that we've seen, in the sense that there is no single price. There are two prices. There is always a bid-ask spread. Maybe on some stocks like S&P 500 ETFs, the spread is small. I believe now it's like 2 cents or something like that. But on other stocks, it could be quite large. If you have orders of hundreds and thousands of dollars, these large bid-ask spreads can give you big losses or gains, right? And so that assumption of the Walrasian assumption maybe is not a great assumption if we want to get into the details of markets, financial markets, of how should we design financial markets, how should we allow people to trade with each other. So especially since 2008, a lot of people, are worried about liquidity in these markets. Liquidity, a lot of times you can measure it by the difference between bid and ask, right? Bid-ask spreads. If bid-ask spreads are large, it's harder to trade basically, or you would trade at bigger losses. And if bid-ask spreads are smaller, you would trade at smaller losses. And so that market is more liquid. Just to give you an example, so I'm showing you here not something that exchange traded, but an over-the-counter market, which is U.S. investment grade bonds. And this is basically a graph of bid-ask spreads. You can see during 2008, bid-ask spreads are shooting through the roof. And so these markets are becoming extremely illiquid in terms of people's ability to sell or buy. So what I'd like to do right now is try to talk about theories of bid-ask spread. Okay, basically just get this one piece of the limit order book, which is the minimum ask price and the maximum bid price, and I'd like to write the theory of that. Question: where are they coming from? Why is there a bid-ask spread? What drives it? So as far as I know, there are two sort of major theories. One is a theory that maybe doesn't quite apply to a limit order book, but maybe it also applies to that. If you think about it in terms of big buyers and sellers, which is that in general, buyers and sellers for each particular stock are scarce. At every moment in time, not everybody wants to sell Apple's stock. And so, there's going back to Muhammad's example, there's an arrival rate of traders that come in and want to sell. And again, the job of limit order book is to match these buyers and sellers. And, in terms of trades are basically determined through bargaining. In other words, we sit, we bargain. So you say, this is my valuation, this is my valuation. This bargaining can have very complicated protocols. Maybe limit order book is one protocol for the determination of this bargaining power. Maybe. But this concept doesn't quite apply to limit order book. It's very well suited for over-the-counter markets. Markets where, I like to sell, currency or carry trade. I would call a person and they would, sell and quote me a price and so on and so forth. So these decentralized market where trades are happening person by person, not in a centralized fashion as in limit order book, maybe this theory is more suitable for that. Another one is, if you want to read more, the paper by Duffy, Garliano, and Peterson, this is the sort of the paper that started this literature on over-the-counter markets and search friction. I have some work on that too, but I don't think we have time to talk about that. So there's another theory which the last speaker today has contributed to that literature, which is this bid-ask spreads come from private information by sellers and buyers. Okay? In other words, when I sell a security, I know about the value of the security. You as the dealer or market maker doesn't know. And so this act of me selling is going to convey some information. And that's going to say, oh no, now you got to ask for a higher price. If I'm sorry, you're gonna pay a lower price for it if I'm selling it. And so what I'm going to do next is basically write this down. So this is a model with adverse selection being applied to financial markets, explaining bid-ask spreads. Okay, all right. So the model there is quite complicated in the sense that it has a lot of bells and whistles because they wanted to show it's very, very general and so on and so forth. But a lot of it I can just explain it to you with very few lines of equations. It's very simple. It's very elegant, and it's being used everywhere now. Okay, so think of a security that we're trading that pays a final value V that can take two values, VL and VH. Okay, so think of it as dividends at the end of the day or at the end of the quarter that the stock is going to pay, and we're going to get those dividends. Dividends sometimes are high, sometimes are low, and the expected value of V is V bar, probability of V being VH is mu. Okay, so mu is sort of market's belief about what is the probability that this Apple stock or whatever you want to think about is going to pay a lot of money, a lot of dividends at the end of the day, or have a high price when I have to sell. Okay, there are two dealers or market makers in this world. These are, think of it as these are people who run the limit order book, right? Who are always hovering around the limit order book, trying to see, or liquidity providers, if you want to think. They're risk neutral, and they know nothing about, this new Apple product that's going to come in, whether it's going to be a great product or a sucky product. A fraction of traders know the outcome of B. So they know that whether the project is if the product is going to be good or not. But a fraction of traders are what we call liquidity traders. These are traders who, want to sell stocks because they have to pay for an expense. I recently did this, so I'll give you an example. You want a, down payment for your house. You have to sell your stocks. You have to sell it. There is no other way to get around it. Whatever price, you just have to. You need cash. Okay, and so these guys are not going to be price sensitive. They're going to sell or buy. You might have to buy also at whatever price that's there. Okay, we can relax that assumption later, but for now, just think of it as and Glaston Milgram actually do relax it. They have more general, where people are heterogeneous in terms of how sensitive to price they are and so on and so forth. But for now, let's just say these liquidity traders just want to sell or buy no matter what the price is. They just have to do it. So, and assume, now we can of course relax that too, is that this is going to occur with equal probability. Okay? It's going to occur with equal probability. So we probably have, if you're an uninformed trader, you're going to sell. Probably half an informed trader, you're going to buy. Okay? Right. Yeah, they are exactly like noise traders. What they don't have to be. We can relax it in the sense that we can say, since I really have to sell this stock, I'm less price sensitive relative to the informed guys. That's what we need. We don't need necessarily them to be exactly noise traders. Okay.
Liquidity providers.
Correct. Or they could also try to screw them too. Correct. Absolutely. It will be, because they have the information. The other guys don't. No, absolutely, that's correct. And again, for simplicity, assume that everyone has a unit demand. So we all want. Again, we can relax that, but for simplicity, I just want to get this bid and ask across. All the assumptions can be relaxed when we actually go to the data and try to back this up. So really, we don't have to make about the dynamics, but think of the dynamic world where these dealers are sitting there. Think of brokers in financial markets, and these traders arrive randomly and in a uniform fashion. In other words, at each point in time, the probability of you being an uninformed person or an informed person is just your fraction in the population. It's your fraction in the population. Okay? Again, for simplicity, all of this can be changed, but you can see how simple this is. These dealers are going to sit there. One of you is going to show up. I'm going to quote you two prices, a bid price and an ask price. The price, to buy from you, and the price to sell it to you. Okay? So, in fact, when you think about it, this is a form of nonlinear pricing. We're not quoting just a single price to trade at. We're actually trying to trade at two different prices. So again, we're coming back to this idea of nonlinear pricing and understanding. Okay. Because there is competition among dealers, at every point in time, the profits are going to go away. In the sense that ask price is equal to the expected value, V, conditional on the submitted order being a buy order. Right? Is there a question? No? Good? Okay. So conditional on the submitted order being a buy order. Why is that? Because, the guy comes in, he submits a buy order, you try to say, okay, either he's one of these two situations, he's an informed guy who thinks the state of the world is bad, so he wants to sell it to me, or he's an uninformed guy who is just selling to me for random reasons. And I based on that buy order, I'm going to update my belief about what kind of guy I'm facing. Again, in case of a sell order, I'm going to do the same. Because there is competition between these dealers, so as I said, I had two dealers who are trying to compete with each other, all of these profits, again, are going to go away. So on all the buy orders, profits are zero, and all the sell orders, profits are zero. Okay? Expected profits are zero. All right, so this is how these prices are determined. This is the bid and ask. Now, can we determine them? So the first result, which is kind of an obvious result, is that when the state of the world is good, the informed guy buys. When the state of the world is bad, the informed guy sells. Not so difficult to think about. It's one line. So now let's think about where the bid and ask are coming from. So at each point, so think of a dealer who saw a buy order. Okay? When you see a buy order, you know, based on this result, that with probability lambda, it's coming from a guy who's seen the world, and he knows that the state is BH. So the probability of that is lambda times mu. With probability 1 minus lambda, it comes from an uninformed guy whose probability is just half. Okay, so this is the total probability of a buy order. So now we have to calculate conditional expectation based on this, which says that the expected value of V conditional on a buy is lambda times mu, the probability that the buy order comes from an informed guy, conditional on probability, times VH, plus 1 minus lambda times half over this, times Z bar. Because in case of an informed buyer, it's just the prior as before. The informed buyer doesn't know anything about, and the decision to buy is not going to send any extra signal. Okay? So when I update my belief, this is going to be my expected value for the final value of the asset. Same thing for the sell. Again, if I see a sell order, it can with probability lambda times 1 minus mu. It comes from an informed person who's seen the state of the world and seen that it's bad, or from an uninformed person. So this is where bid and ask are coming from. It's as simple as that. Now you can think of putting more bells and whistles on top of this. Think of people who have valuations between bid and ask, so that creates illiquidity in the market, because these people who are in the middle are not going to be willing to buy or sell either. And you can do all sorts of stuff with this. You can extend it, for example, to have different valuations, all sorts of private values, all sorts of stuff. But the gist of the theory is that bid-ask spreads or illiquidity is coming from this private information. Private information is hampering trade. Okay, so now, once the trade actually gets executed, people update their beliefs. If you see a sell, I think I have this, no, I have this reverse, sorry. If you see so this is buy. If you see a buy, you know that that if it happens to be an informed trader, the value is good. So your new belief is mu over lambda mu plus 1 minus lambda over 2. Yeah, so this is the probability of a buy. This is the probability, the conditional probability that it's coming from the good guy, the informed guy, and vice versa for the seller. And over time, dealers update their beliefs, and in the limit, the bid-ask spreads are going to converge to the same thing. Because basically, at the end of the day, you're going to know exactly what the state of the world is. So just to give you a computation of this is what typically it would look like. You start from some bid-ask spreads, an order arrives, bid-ask spreads fall, prices also fall. Bid-ask spreads fall, another reverse order arrives, bid-ask spreads rise, prices also rise, and then again, these sell orders are coming in, causing prices to fall, and bid-ask spreads also fall over time. So this is a very simple theory of bid-ask spreads, or where illiquidity comes in the markets. A lot of people have sort of tried to estimate the value of this. People have tried to extend this to very, as I said, make these liquidity traders price sensitive. They don't have to be exactly as price sensitive as the informed guy, but they can be less price sensitive. For example, you can put more general stochastic process for the payoff of the stock, difference in order sizes. In terms of empirical work, Easley and O'Hara are the guys who try to actually go and measure this. So they try to estimate this based on sort of daily trade data, try to see how much adverse selection is out there. Okay, and people do decompose bid-ask spreads into an adverse selection premium, a liquidity premium, and so on and so forth. And so by now, Glossop-Milgram is very influential, and there's a standard practice in doing market microstructure in finance. So, you know, what are the issues that we're sort of dealing with right now? As I said, I have some work that tries to decompose this idea of search and bargaining versus private information. There, our goal is to try to basically see if illiquidity is coming from private information or just from the fact that buyers and sellers are scarce. Yeah. No, really what we want to know is this. No, it's not really transaction cost, because the way you're thinking about transaction cost really falls in the search and bargaining category. So yeah, maybe you can think about it that way, because this I wrote down, there's no transaction cost there, right? The bid-ask spreads are coming from private information. Oh, that. Sure. Sure. So that would be, no, I understand that. So for that, I don't think by just looking at prices you can tell. What you need to do for that is to look at how much quantity is being traded and correlate that with prices. Basically, you need like a structural model and go and estimate this structural model in the data, which I don't think is very easy to do. But yes, that's another thing. Just because pure risk-sharing reasons, I might want to dump my stocks or buy some stocks. Do all of that away. Another issue that's particularly important now in market design is high frequency traders, which is that now technology allows to execute trades in the order of microseconds, maybe even less. And some people, have argued that, so the argument that they give, these high frequency traders give, is that we provide liquidity. We're always there. Anytime an order arrives, we're willing to execute it, and we're providing liquidity. That means the market is more liquid, and so on and so forth. The argument that's given against them is this idea that they try to actually front-run market orders, in the sense that basically the losers are going to be those guys who have to sell their stocks to buy a house. And the HFT guys are basically always trying to guess what these guys are doing, because they can arrive at, in the marketplace in a faster way. They always try to front-run them and sort of screw them out of their orders. So there is a recent paper by Eric Budish, Peter Crampton, and John Shim at this point. I don't think we know the answer to that yet. Because there are also some work in finance that actually says that HFTs have been valuable in the sense that they did have to provide more liquidity. So these are all interesting things to work on, actually. Another thing that sort of we've seen in the past few years is that the number of trading platforms in the US has increased. It used to be that New York Stock Exchange was just one place and all trade happened at the floor there. Now we have all these different computer or servers located around New York and New Jersey and so on and so forth. And there are all these different regulations about how orders by brokers must be executed. In other words, which bit of it are you going to send to the closest exchange, which bit of it you're going to send to the furthest exchange. And all of these issues are sort of, are regulatory concerns that we don't quite have answers for. I think, again, it falls in the area of market design. Another issue is transparency of prices in the counter markets. After the crisis of 2008, so a lot of people thought that, at least in the government, thought that they don't have good information about what's going on in these, bond markets, for example, which are over the counter markets. And so now the question is, if we force these guys to announce trades and prices and so on and so forth, is that actually valuable or not? So in the sense that, does that lead to more liquid markets or not? Does it lead to lower bid-ask spreads or not? Again, that's an area of research if you'd like to read more about it. I have probably 5 minutes. I'm going to talk about empirics. Not going to talk about any of these. Okay. So empirics. So the issue is, how do we measure adverse selection, basically? So we've posited all these theories about, private information, and we've sort of posited that maybe there is private information adverse selection going on in used car markets or insurance markets. But bottom line is we'd like to go there and test whether that's the case or not. So basically the key question is there adverse selection in certain markets or not? The issue is how are we going to know? In other words, we're going to see, if we look at certain markets, we're going to see a bunch of prices and quantities for certain products, and how can we possibly tell? So one idea would be to look at trade volume, but so inspired by, so take the Glossop Milgram example that I give you. In that world, if there is a lot of adverse selection, bid-ask spreads would be large. If there is very little adverse selection, bid-ask spreads would be small. So volume perhaps is correlated with adverse selection. But volume can go up because of all these other reasons that we were talking about. Volume can go up for all sorts of different reasons. Bid-ask spreads can rise because all of a sudden people are getting impatient, for scarcity, for risk sharing. If the world is consisted of a bunch of risk-averse guys and risk-neutral guys, if volatility goes up, everybody wants to dump their stocks, and volume can go up and down because of it. So looking at volume perhaps is not super informative. Another one to try to see is to look at so basically the approach that I've seen being done in the literature typically is to look at market data and try to look at post-trade. So say we're talking about insurance, for example. Look at accident experience of drivers, for example, and see if that experience is correlated with how much insurance they bought. Okay? So think of the example that I gave you. What was the key implication of that model? The key implication was that the high-quality guys bought less insurance, basically. Or, high-quality car owners didn't sell their cars. Right? This is a cross-sectional implication coming out of the model, and it wouldn't be true if it wasn't for adverse selection. I mean, there is some arguments about, maybe moral hazard also leads to that, but let's ignore moral hazard for a second. So one approach to try to do this is to try to look at the post-trade behavior of traders in insurance markets, for example, and see how that is correlated with their actually trading activity, what they chose. And see if that has a certain correlation, then we can maybe say that the market has adverse selection. So this is what I was saying. In most of the models in all the models that I talked about, in most models, we can argue about that, and I'll talk about that a little bit at the end. Quantity, and particularly in insurance markets, quantity and risk types are positively correlated. The riskier you are, the more you're going to buy. Okay? Perhaps if we can observe that, we can say there is adverse selection. There's an important caveat here, which is that if you're an econometrician, you look at the data. What matters for adverse selection is what the insurance company actually saw at the time that they were trying to sign the contracts. If they saw all your past behavior and you as an econometrician don't see this is an information that's being used in pricing the contracts and you don't know it. And so you might look at it and say that there is actually adverse selection where in fact there is none. Okay? So there is always that issue that we always have to be worried about. There's a very nice paper by Salanier and Shourideh, which is they look at young drivers in France. So these are drivers who've gotten their license in the past 2 years. So that issue of past information, past accident behavior, and so on and so forth, is not really a concern for them. Presumably, what they see about their age, education, and gender, and so on and so forth, you as an econometrician also see it. Okay. So what do? Basically, they run two key regressions. One is they look at, so here Y is choice of coverage. How much insurance, so think of it as whether you decide to buy an insurance or not, or how much, again, back to franchise, how much copay you decide to have. And Z is the occurrence of accident, whether there was an accident or not. So you run this regression. In a world with adverse selection, these two are correlated with each other. The error, so X here is the characteristic, age, education, parents' education, whatever you have, whatever you want to think. If epsilon and eta are correlated with each other, that says there is something that the guy knows that determines the accident probability. Right? And so basically the test would be to test whether epsilon I and eta I are negatively correlated. Without adverse selection, they won't. So what is the result that they found? They're not correlated. Which is basically they thought, okay, this means that this is a market where we all thought there would be adverse selection, yet there is none. Okay, how much time do I have? 2? 2 minutes. I'm going to take 2 minutes and talk about what is the caveat in this test. Okay, so, another sort of problem, as you see, is that maybe our models are wrong. Our key implication that we relied on was based on a one-dimensional model. We said that we sorted people into risky and less risky, and we said the risky guys should buy more insurance. But in reality, maybe the risky guys are the guys who are kind of crazy. They don't want to buy insurance. Maybe the less risky guys are super risk-averse guys who would like to buy a lot of insurance. That could sort of change this correlation. And so maybe that test actually has absolutely no information for us. If we think the underlying underlying distribution in the world is like that. So Finkelstein and McGarry said, okay, so there's this problem. We need direct tests. So what they did was they found, this interesting information, which is, so what they were looking at was long-term care insurance, whether you end up at insurance for the situation where you end up at a nursing home. Okay? So, they went to these, so they found this survey which asked people 5 years when they, 5 years prior to the end of of their data set, whether, what they think is the probability of ending up at a nursing home. In other words, what do you think is the probability that you will be in a nursing home? Okay? This is an information that they knew that the insurance companies didn't have because they saw what the insurance company had. Okay? So if this information is correlated with the outcome of whether the guy ends up at a nursing home and is not priced in the premium of their insurance, then we would think that there is adverse selection. And so basically that's the gist of the test that they ran. They effectively said, so this was the question. So, of course nobody wants to go to a nursing home, but sometimes it becomes necessary. What do you think is the chances that you will move to a nursing home in the next 5 years? This is correlated with the outcome beyond the variables that are observed by insurance companies. And, again, they ran the same sort of regressions. What they showed was that, so basically that these beta 2 and delta 2 are significant variables, but also they showed that the same test, if they run the Chiapori-Salanier test on the same data, again, they're going to reject it based on their test. In other words, we don't see this negative correlation between risk and coverage. So that suggests this multidimensional story where, maybe the guys who are risky or less healthy or, are the guys who are also very risk averse and they would like to buy a lot of insurance. I'm going to stop here. That's it.